This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, welcome back to the channel. And what I wanted to explain to anyone new to these videos is that this is definitely not a beginner course in technical analysis. If you want to go and find another channel to learn sort of the basics, this channel is going to take it to the next level, in my opinion, in terms of looking at multiple time frames, going into momentum, how to use price and momentum together, especially when we're looking at entries, trying to improve entries and have a much better understanding of price structure. And what I'm going to talk about today is price structure in multiple time frames, really on a pullback trade, actually two different pullback trades, and how the moving averages help to confirm how you use them together. All right, so let's go ahead and get into this. So I've got the zigzag up because whenever I talk about price structure, I want to be able to explain what that means. So price structure essentially is the movement of price making higher lows and higher highs and or lower highs and lower lows, or we could just be making neither of that, just kind of having a flat trend. But what it does is help us define the trend, and by so doing, we can determine and have an edge as to when we want to enter price on a pullback. So if we know the trend is up, we can play a simple pullback on this monthly chart, and a simple pullback meaning all we're doing is going up and then moving down in a straight line, no intermittent lower highs and lower lows, just a straight line down. That's a simple pullback on this time frame. And now this is a monthly chart. Now, I like to look at the moving averages because even though independent of that, I can look at the price action and it can give me what I need to know. By using the moving averages in conjunction, we can anticipate where support should come in. The 18MA, in the area of the 18MA, when it's rising, will provide support in a trend, especially when it's supported by the 40 and it's going in the same direction. So if you have an 18 and a 40 rising, you can anticipate where we're going to expect to find support in a pullback in a trend in either direction, both ways. All right, now when we look at this simple pullback on a monthly chart, look at what that is on a weekly. Weekly, it made a move down, right? And then it made a lower high, a lower low, lower high, lower low. I mean, we're trending down on the weekly chart, while on the monthly, all we're doing is making a simple pullback to the rising moving average. Notice also during these lower highs and lower lows, we eventually get the 18 to cross down below the 40, right? We've reversed these moving averages to the downside. At one point, they were in agreement with the monthly, but now these have gone in the opposite direction. This is really what we want to see. We want to see the lower time frame going in the opposite direction when we're buying a pullback trade. We want to look for when the lower time frame is basically going in the opposite direction of the higher time frame. So I've got a rising moving averages here, and on this time frame, it doesn't necessarily mean I want both moving averages rising or falling, but I do want the 18 below the 40, and I want price to be below the 40 as well. So once we have that, we can start to look at what, essentially what we're trying to identify, which is I want to buy a pullback in this time frame, but I want to use this time frame for the timing. All right. And so, again, I want to focus in on the price structure because if we're making lower highs and lower lows, well, the reverse of that would be higher highs and higher lows. And if you notice the way this played out, we went to a new low here after basically trending to the downside, and then we moved up and we made a higher high. All right. Now, that doesn't mean the trend has shifted, but it's an alert. It's a bull alert that things are potentially shifting. And then we get a pullback and we make a higher low. Now, once we've made a higher high and a higher low in the lower time frame, okay, just understand we're trying to get on this. We're trying to get in on this trend, which is clearly up. So the moment we start to see signs of a bull alert to the upside, we want to pay attention and close attention at that. And it really takes a move to get this to turn up, this has to move up like this to get the zigzag to turn back to the upside. It takes a little bit of work. It's not just going to go the moment this turns up like that. So once we cross both of these moving averages, we're essentially in a bull alert where we've made a higher high and we've made a higher low. Now our antenna should go way up. We should be looking for some form of a signal. And this is where the momentum signals can come and be very helpful. Like looking for a pinch play here. We made 2 lower highs, and in fact, that was a pinch play, as I remember on the chart. So what we're going to want to do is use the lower time frame price structure to help us to anticipate when a reversal is taking place to really improve the timing. And I do think this is a very helpful tool, the zigzag. Now, I'm using stock charts for this video, and the 2 multiplier, so you pull up the zigzag and you use a multiplier times 2. That's what I would recommend. Essentially what it's doing is taking 2 ATRs, okay, and it has to make a 2 ATR move off the low in order to reverse the zig to a zag. Okay, so that's why I like using the 2. I use 2 ATRs for anyone's taken my course. I use that a lot in a lot of different things. I find that to be a pretty good approach, the 2 ATR zigzag approach when it comes to multiple time frames. So I can start to anticipate on this time frame because I know this time frame's in an uptrend. I know I've got good support underneath here. Now, if we go to the daily and the hourly, so let's just look at this pullback on the daily. This is a pullback to the rising moving average. Same thing, right? The markets are fractal in nature. We can keep dividing up the market into smaller time frames, and you're going to see the same patterns opening up over and over again. Now, one thing we don't want to ignore is the violence of this pullback, but we do just have a simple pullback on this time frame, and we're clearly in an uptrend on this time frame. So once we go to the smaller time frame, we start to use the same approach. Now, instead of making lower highs and lower lows and really reversing the trend, we made 1 lower high and 1 lower low. Okay, and we didn't continue that down and keep trending to the downside. So when that happens, you want to be a little bit more on the alert for a reversal to the upside. And a few things that took place here that you can't see on the daily chart, all right, is we undercut this key level at 115 and came back above and made a higher pivot low. This is essentially an undercut and rally pattern. Now, you'd use the low of this pullback as your entry on that type of a setup, but it's pretty clear to me when I look at it this way. Now, why am I not waiting for a little bit more confirmation? Well, you certainly can, but if you don't reverse the trend to the downside, then you don't have to reverse the trend back to the upside to get entry. Do you see what I mean? We have to have a trend to reverse. So if the trend has only made an ABC down, you can look to be a little bit more aggressive, and the first aggressive entry would have been an undercut and rally here. Now, as it turns out, it ended up taking a little bit of time to getting going. Now, I want to show the reason why I put this trend line the way I did. If you notice, we made a lower high, lower low. We can't really draw a trend line down like this using the zigzags. The reason why the zigzags can be very helpful with trend line analysis is it helps you to be consistent. We have to have a strong enough reversal to be considered a peak or a valley, a support or resistance level to be able to draw and use as an anchor point. Well, in this case, we made this secondary peak here, lower high. We have to use that as our anchor because there was not another lower low made. This stuff is right out of my course. If you need a little bit more detail, I would definitely suggest, going and taking a look at that. It's on rabilstockresearch.com. So here's the thing. Once we've had this bottom in place, okay, now we're kind of stuck in no man's land because we have a trend line here and we have made a bottom or an entry, an aggressive entry on this point. But if I'm looking for where I think the trend is starting up again, it's kind of like where I'm not only getting the price improvement. So here we had a move to the upside, but the 40 was clearly down. Yeah, the 18 found support. But, based on the violence of the decline, I'm not really usually looking to play the first move, right? That's why I pointed that out on the daily chart. This was too violent to really want to play the first signal. So I probably, even though that is a more aggressive entry and we don't have evidence of a reversal, we go and use the momentum after we've figured out what's taking place in the price structure. So in this case, I probably wouldn't take this entry myself because of what's going on in the violence of the decline and what the MACD is showing. So we wait for our second entry, which is clearly a move up through here. We break the trend line, and then when we make a higher low, notice how the moving averages are turning up in our favor. To me, this is really the entry for this setup, and it's more of a swing trade when you're looking at a daily and an hourly, but the point is still true. What I'm trying to show you is when you use price structure, you should be able to anticipate, get a real good feel for where the reversals are taking place. I really encourage you to use a zigzag on any of the programs. You can do it on TradingView. You can use it on any really. But if you're going to use if you're going to do that, use it in conjunction with the moving averages and see if you can get the same signal developing on both. If you get the same signal developing on both, the odds of your timing really being good is going to skyrocket. So, most of the people that I talk to that are subscribers, I tell them, look, you don't realize how much better you're getting at figuring out the timing. I mean, most of my guys know somewhere in here is really where we want to be looking to be a buyer, right? Because we're pulling back on support and we know we have too much overrun on the decline. So we're probably waiting for the second entry, which is somewhere in this region over here. I mean, if you can get it down to that point, you're ahead of 99% of the people out there. And that's the whole reason why I like to use 2 time frames together. All right, so keep studying this. Use your zigzag. What I recommend is I have a layout that has a zigzag and I have a layout that doesn't. All right, I want you to be able to see what's going on in the moving averages and the price action. I want to look at the individual bars, but then I also want to look and overlay what the zigzag is telling me about the price structure. If you can use those two together and you can get signals that are giving you, basically overlapping signals that coincide with one another, your timing is going to improve dramatically. All right, let me know if you have any questions and we'll see you next time.